Kia ora, I'm Nadine Higgins and welcome to the Prosperity Project. With what is going on right now in Iran, and while we're at it, Israel, Palestine, Russia, Ukraine, Afghanistan and Pakistan, the world sort of feels like it's on fire right now, right? And at times like these, the traditional financial advice is sit tight, don't panic, think long term. But what about the people who manage money for a living? What are they thinking, doing or not doing when war erupts? Sam Dickie is a senior portfolio manager at Fisher Funds and he's with us on the Prosperity Project. Thank you for being with us, Sam. When you get the notification in the nighttime or you wake up and read the news that Israel and the US have attacked Iran, what is your first action?
And thank you for having me on, Nadine. That is absolutely key because investors don't and shouldn't position long-term portfolios, long-term investments for these sort of low probability, very human tragedies, by the way. And I often find it a bit awkward to talk about these things through a markets lens, given it is a real human tragedy, but they're kind of sort of low probability, high impact events. And it's really hard, in fact, impossible to position your portfolio for that. So the very first thing you do is you triage your risk. So if this gets worse, for example, and the risks manifest in many different ways other than just the obvious being oil, how am I positioned? If it gets much, much worse, which of my companies are most at risk, most exposed to this? Do I have any positions in my portfolio that I was kind of thinking about selling anyway? They were on the way out. They might have served their purpose, that the thesis might have played out, or the thesis might have changed. So do I have low conviction positions in my portfolio? But equally, you've got to be really symmetrical here. So is there anything I was thinking about buying yesterday and it's just gotten a whole lot cheaper today? So those are the sort of things you do, is triage your risk and look to play both defense if you don't think you're well positioned and offense if you think you are well positioned.
So that's the old buy the dip strategy on the opportunity side, that if you thought something was a good bet yesterday and now it's 8% cheaper, well, it's an even better bet today.
That's right. Especially as in these events you find we often call them high correlation events. So often when people panic, everything goes down together. I guess it's the opposite of a rising tide lifts all boats. I'm not sure what the saying would be there, but when you see that and you see sort of indiscriminate selling, and I'm not saying that's necessarily happening here, but often with these low probability, high impact events, you'll see that, then you can get a great opportunity to buy a really good business at a cheaper price today than it was yesterday.
That said, we obviously knew that the US was kind of rallying the troops, for want of a better phrase. We just didn't know exactly what they were planning or when. So were you trying to triage the risk ahead of anything happening, or were you just kind of biding your time? What goes through your mind?
I think as a professional investor, you're always triaging your risk. So you stress test your portfolios based upon numerous things, spikes in oil prices, shocks in economic growth. And part of that is, at Fisher Funds in particular, for 28 years, we've had a real quality investment style. So what I mean by that is we're investing in companies with really strong balance sheets, really long-term thinking management teams, wide and widening economic moats, and long growth runways, almost irrespective of the economic backdrop. So that sort of ethos and style is a form of stress testing. But outside of that, we run scenarios on a number of shocks, including a spike in oil prices.
When you say a wide economic moat, what you mean a company that's going to do well kind of regardless of what's happening in the economy? Do such companies exist?
They do.
Are these the supermarkets? Everyone has to eat.
Well, yeah, I mean, that's a very defensive earnings stream. But I guess a wide economic moat is a certain specific set of circumstances and quite unique set of circumstances that allows a company to protect itself against the ravages of competition or anything that might eat into its sort of supernormal returns it can make. So, for example, scale is a classic one, and that sort of flywheel of scale. So if you're the biggest in the industry and you have the best people working for you, you've got the ability to invest more in and things like AI opportunities or bigger factories, for example, which will drive down your cost to produce, and that sort of feeds on itself, and you can drive up your margins and continue to take market share. Another one is a brand, for example. So a really strong brand moat, for example, is a big moat. So Apple, for example, Gillette, Coca-Cola. A third one, and this is sort of less well known, is the super powerful network effect. So what that means is for every new customer that you get on your product, that makes it more valuable for the existing customers. And really simplistically, think about MasterCard there that has a two-sided network effect moat. So if you didn't have a credit card, what's your favorite restaurant or the cafe just outside here?
Oh, bread and butter.
Bread and butter. Excellent. Sounds very, very solid, very basic. I'm sure they serve more than that.
Yeah.
If you didn't have a credit card and they had a credit card terminal and then today you got one, that makes the network incrementally more valuable for all of the merchants on the network, and certainly for bread and butter, because you can use your MasterCard there. And equally, if bread and butter didn't have a MasterCard terminal and you had a MasterCard and they got one today, that makes the network incrementally more valuable for you. So it sort of locks you in as a customer and a merchant. So those are some of the types of economic moats I'm talking about.
Obviously, the traditional advice to your, I hate this term, but for want of a better one, mum and dad investors. So your average Joe who's got KiwiSaver, maybe has a managed fund, whatever, some individual shares, is to sit tight. Do not make decisions based on what's happening today when you're actually investing for your retirement. Kind of the keep calm and keep invested strategy. I take it, though, that's not what a professional portfolio manager can afford to do. So are you buying and selling on the back of an event like this, or are you sitting tight and waiting? Like, how does it work?
Well, I think going back to that first point is we're always triaging the risk, but equally these things weren't necessarily going to happen. There's been many events in history where you expected something to happen and it didn't. And a good example I always think of this is when Trump was first elected. So the market was 100% convinced he wouldn't be elected. Mm-hmm. And in the unlikely event that he was elected in 2016, the market was 100% convinced that the stock market would go down very sharply. So they were wrong on both counts. He was elected, and in the ensuing 12 months, the stock market went up 21%. So the point there is, even if you had tomorrow's newspaper yesterday, you still wouldn't have made any money out of it. So I think of course, we're always triaging risks. They may not happen. And most importantly, and I think Ukraine was a good example of this, the risks you expect to manifest may not manifest. And what I mean by that is the transmission mechanism there was going to be energy prices and soft commodity prices. In fact, the oil price peaked before Putin invaded Ukraine, and soft commodity prices spiked pretty rapidly, but about 3 months later, they were much lower than they were previously. So again, even if you got it right and knew that this was going to happen, often perverse outcomes happen, and I'm happy to sort of talk through some of those other unintended consequences as well. Yeah,
and we will get to that after the break. But I suppose when it comes to ructions in the Middle East, which we're no stranger to, there's a typical set of knee-jerk reactions, right? You know, if we're talking about shipping channels like the Strait of Hormuz, if we're talking about oil-producing countries, then there are some obvious ones that are sort of the first cabs off the rank.
That's right. And every time one of these things happen, and when you're triaging your risk, obviously it's important to see what are the most acute first round risks. And this has been well documented that oil and the potential restriction of supply of that oil will be the most obvious first round impact. And then, for example, when you're triaging your risk, as a mum and dad or a semi-professional investor, you start to do things like, well, which of my companies are economically cyclical and might be impacted by a spike in oil prices? Because all a spike in oil prices really is a tax on growth and a potentially inflationary impact. So both of those things not good. The second thing is, am I invested in countries that are more exposed to a spike in oil price? So lots of countries in Asia are still to this day big net importers of oil, so they're short oil effectively, and that's part of the reason why you've seen some of the Asian stock markets react really, really much more savagely to this than the US.
So the world isn't any less exposed to oil prices than it was 15 years ago, as there's this electrification move. We're still very much if oil prices go up, as you say, tax on growth, inflationary impact.
That's right. I mean, we are still very much a fossil fuel global economy, although last year there was some good stats about how much solar was added around the world, and most of that in China, actually, incidentally. So we are still very exposed. A lot of those Asian countries that used to be very short oil, and in fact, the US was very short oil as well before the shale revolution. So if you go back sort of 15 years ago, this would have really hurt the US, for example, but now they're self-sufficient in oil, given the fracking and the shale revolution, the domestic drilling for oil.
And their invasion into Venezuela, did that help?
They're much better positioned. No comment.
Sorry, I don't mean to get you political, but it is often said that these things are motivated by things like access to fossil fuels.
I'm absolutely sure the rumours are true on that. And some of those Asian countries, so big tiger economies like India, for example, that used to be absolutely its Achilles heel, is this kind of spiral effect by the fact that they were very short oil, so they need to import a lot of oil, and there would be an immediate reaction in their currency. So if the price of oil spiked, their currency would usually weaken in response to that. And this is this sort of second round effect I was talking about before. And that, if you think about what happens there, is not only is the oil price going up in US dollars, but the Indian rupee is depreciating against the US dollar, so the price of a barrel of oil in Indian rupee is spiking, and that feeds on itself until you get a circuit breaker. So the point there is India's insulated itself a lot more than it used to be, and so is China. So a lot of these countries are trying to balance the books on oil, but they're still short oil. So,
like New Zealand, right? We don't have a refinery here anymore. The New Zealand dollar's pretty weak. Oil prices are high. This could have a very real impact on our inflation and our growth.
Yeah, the price at the pump is just a real tax on growth, and it's and I guess what we need to watch for is that stagflationary impact. So what I mean by that is it's a tax on growth, and I always think like this: how does it manifest? So imagine you're sitting in a boardroom in Middle America, and you're about to sign off on a $1 billion capital project. You're the chairman, you're one of the directors. It might be a series of factories. It could be anything that's going to cost you $1 billion. And while you've done all the feasibility studies, it was sort of a line ball. It was a 55-45 call. And just say today was the day you were going to sign that check, I reckon it might just give you pause, given we're in a full-blown war. So it's that confidence transmission mechanism as well. So it's confidence, it's a tax on growth. I mean, we literally will drive less if the oil price spikes. And then if we see inflation coming through, and oil sort of feeds into a lot of other commodity prices and textiles, etc., then you can have a slightly awkward scenario called stagflation, whereby growth is slowing, but inflation's going up.
Yeah, which is a really uncomfortable position to be in. We're going to talk a little bit more about those cascading impacts that you mentioned after the break. We'll be back right after this. Welcome back to the Prosperity Project. We're kind of talking about how you invest when it feels like the world is on fire, which is, to me, how it feels at the moment. Sam, how much of what you're deciding to do or not do when you're looking at your portfolios that you manage is based on data? And how much, is there any gut feel involved in it?
We try and take out the gut feel as much as possible. And in fact, that's a big part of a portfolio manager or fund manager's job. Is, I think my colleague said it best once, human beings are riddled with and swimming in bias. It's just a truism. So we try and take away as much of that bias with process and a scalable and repeatable process. In terms of data, I always thought my boss in Hong Kong used to say it quite well. He said, God can turn up with a hypothesis or a theory to a meeting, but everyone else bring data. So we're always trying to prove everything.
Yeah, okay. So what sort of data are you looking at the moment to try and figure out how best to invest in an environment that seems extremely unpredictable? And I know some investors might be familiar with the volatility index, the VIX. Does that tell you anything other than that everyone's panicking?
Yeah, I think that you said it well there. Is it does tell you that everyone's panicking, and as we've discussed, you're really saying, put your head out the window and tell me if it's raining, and you put your head out and it's absolutely raining. So the fear gauge or the VIX is important, but I think just seeing spiking commodity prices it would be obvious that VIX would be there would be a high VIX given this. Now, what is happening is, under the hood, there's been a lot going on this year. So on the face of it, the S&P 500 is fairly flat, but you've seen extreme dispersion going on. So what I mean by that is energy stocks are up sort of 25% year to date, and software stocks are down 20%. So a 45% spread in big sectors is extremely unusual. So we're seeing money rush around in a very concentrated fashion into very specific themes. Last year it was AI. More recently it's become memory. And I do want to talk about Korea really briefly. Memory is the key bottleneck for AI right now. If you remember 2 years ago when you typed into your ChatGPT, there was no reasoning or thinking. It was just, who was the president of the United States in 1928? It was just boom. Now these models are all thinking and reasoning, and that requires a whole lot of memory and context, and memory is the current shortage, so everyone's rushing into memory stocks. This is before.
So this is the NVIDIAs of the world.
Well, it was NVIDIA sort of more earlier on last year. I mean, that was an obvious AI winner. Now it's, high bandwidth with memory manufacturers like Hynix, like Samsung, like SanDisk, like Micron. So that is, the money sort of rushed into the most acute bottleneck in the massive AI infrastructure build out. The other thing that people have been crowding into before this was 4 days ago, was much lower quality companies in the US, companies with higher debt on their balance sheets, who are going to be big beneficiaries of a potential cyclical recovery in the US. People are clearly crowding into precious metals, for example. So the point is, these things change every few months. It's very aggressive, and it's very concentrated investing, which is very risky. Yes. And then some of that started to unwind. So this may have been the catalyst. So if you look at the Korean stock market, which is about 45% of the stock market is two stocks, which is Samsung and Hynix, that's down 21% in 2 days. Now, you do not see stock markets fall 21% in 2 days. In fact, it was down 12% in a day, which is the biggest one-day drawdown in its 46-year history. So we're seeing some very extreme dispersionary moves below the surface.
The old saying used to be that if you're hearing stock tips from the shoeshine boy, when everyone's figured out that NVIDIA's the big play in AI, for example, you've missed it. Everyone's made their money and you're last to the party and you're the one who's most exposed. Is that one of the risks that this running around from this hot sector to that hot sector is currently presenting?
Very much so. It's a risk and an opportunity, and that is a point very well made. So when everyone's crowding into memory and crowding into Korea, crowding into low quality small cap companies in the US, you just know that at this stage, when it's on the front page of the newspaper and has been for weeks and weeks and weeks, it really is potentially the greater fool that's buying these sectors. So you just need to be very wary.
So how do you get to be the one who's investing there first, rather than the one who's reading it on the front page of the newspaper and joining the party a little too late?
Well, I think first of all you've got to have a process and a style, right? And I think this is one of the exciting points I wanted to point out is, quality companies as a bucket, as a basket, as a group, are having their most acute underperformance in 30 years because people are rushing into lower quality companies. And Hynix is a good example, actually. Phenomenal company, but if you look back over 15 years, it's made losses in 2 of those years. It's had 3 or 4 times where its profits have gone up by 500%, then fallen by 85%. So that's not something we'd call a blue chip quality company. So the flip side of everyone rushing into this lower quality stuff and playing the shoeshine person phenomenon is blue chips are getting left behind. That's a huge opportunity. The second point is, I think you've just got to have a really decent margin for error, as sort of a famous investor, Ben Graham, used to say. So what's your margin for error when everyone knows about a company, that the valuation is expensive, it's very crowded, and there's a lot of retail and flighty money in there? You probably don't have much of a margin for error, and that's what the Korean markets told you in the last couple of days. Equally, back in mid last year, some really high quality cyclical trucking stocks in the US, like Old Dominion, for example, that Mainfreight here models itself on, had been in a 3-year freight recession. They were still quality companies. Investors had given up, fallen out of love with them. They were very cheap. They were very underowned. Their earnings power was very understated. So when you've got a huge margin for error like that, there's not a lot of downside and potentially a huge amount of upside. And on that stock in particular, we haven't even seen the cycle turn yet, but the stock's up 70% from its lows, just on the sniff that the cycle might at least be bottoming. So look for a margin for error.
What do you make of gold at the moment? Because when everything's uncertain, that seems to be where everyone flocks to. But it's at, new record highs every other day. Everyone's already there. So what role does that play in being a safe haven asset when it's already expensive?
Yeah, I think that's an excellent point. And this is the point you and I are making on this crowding, right? So investor positioning matters. If you're being told about gold by the shoe shine person, probably chances are it won't behave like it normally would in a safe haven washout, and that's what we're seeing right now. But gold generally, it's got 3 or 4 purposes. One is it's a safe haven, and it has had an extremely good track record if you look back over 100 years. So, in the Depression, in the 1930s, in the 87 sort of Black Friday, the Asian financial crisis, the GFC, COVID crisis, it's at least held its value, but usually rallied throughout this period when equity markets are falling really sharply. This particular little mini crisis we're going through at the moment, I don't want to make light of it, but in terms of how the stock markets have reacted so far, gold hasn't worked. And to your point, it's because people have crowded into it, and maybe the shoe shine person's talking about it a little bit too much.
You made a really interesting point there about what history can teach us. We need to take a quick break, but we're going to ask that question after this. Welcome back to the Prosperity Project. We're talking to Sam Dickie from Fisher Funds about how to invest when it seems like volatility is the word du jour every day. But when it comes to the Middle East, and I mentioned this already, Sam, that we have been here before many times in terms of conflict and in oil-producing countries and countries that dominate the Strait of Hormuz. So what can history teach us? Or can it not? Is it the old past performance is not an indication of future performance?
I think history is, frankly, the only guide we've got, and there's always nuance. I think a famous US investor said it best when they said, when it comes to geopolitics, very few people on earth have a clue about what's going on and most importantly, what's going to happen, including sometimes the people who might be waging the war themselves. So if that we
That's
always,
reassuring, isn't it?
well, reassuring, but probably true. And if we start with that as a sort of our humble sort of level setter, I think history is important. So I think if you think about the Middle East, North African region, in the last 4 decades or so, there's been 26 sort of major sort of airstrike quasi-wars that have gone on.
26 in 40 years.
Yeah.
Wow.
And in 95% of those cases, the stock markets were higher 3 months later. So history does tell you that. That's interesting. It's certainly not a guarantee of future performance, as you said, but it's context. The other thing that's really important is the nuance. So which historical period should you compare to? So the first thing to think is, what is the acute risk we're all talking about? So
Donald Trump?
Is it erratic policy making, for example, is going to be the transmission mechanism?
Yes, that was euphemistically put. Thank you.
Is it oil? Is it energy prices? Is it soft commodity prices? Is it a credit event where we see a big credit crunch, for example? So it's important to kind of isolate the transmission mechanism, which in this case is probably oil. And then you can start to compare to those periods. And I think it is helpful. But the nuance, which you've pointed out a few times, is things like investor positioning coming into this is really, really critical as well.
How the markets have performed doesn't guarantee what is going to happen, but what we know from history is that typically the share market is higher in 3 months' time. And I think you said even if you had tomorrow's paper yesterday, it might not help you. Does that bring us back to just go back to your goals, stay the course, think of the long term? Without wanting, and leave professionals like you to think about the frameworks and the forward-looking indicators and all of those things.
I think, I really do think if you follow that process, so triage your risk initially. Do I have any kind of loose risk or risk I'm not that convicted on? If you do, and if this continued for longer, will that be impacted? Well, then potentially you should tidy things up. Equally, look to play offense on the other side. That's the first thing. The second thing is the framework. Look at history. Look at how this is going to cascade in terms of the risks, and watch those road signs. So watch interest rates, watch other commodity prices. There's lots of sort of real-time inflation expectation indicators around the world. There's lots of longer-term inflation expectation indicators. There's lots of real-time economic activity indicators around the world. If you start to see inflation expectations picking up and real-time growth activity slowing down as that director or chairman didn't sign that euphemistic check, for example, then it feels like maybe this is starting to cascade a bit.
And if you were to look into your crystal ball, what is it? What are those road signs telling you? Is this going to have an impact on growth, on interest rates, on consumer behaviour, or is it going to be isolated to, a few weeks, possibly awful human tragedy, but are we necessarily going to see financial tragedy following that?
I think, look, what I don't know, and I don't think anyone does, but what historic analogues am I looking at? And certainly during Trump's regime, I think we've learned that he doesn't really care about Wall Street. So if you go back to Liberation Day, he was really he was really driving hard on those tariffs and ratcheting up the rhetoric with China, and Wall Street was selling off really aggressively, but he didn't blink. He did blink when it looked like Main Street was going to be impacted. So you saw people start selling
the bond market.
US dollar, the 30-year bond rate was starting to go up, which is the primary instrument that the 30-year mortgages, which is 90% of mortgages in the US, is set off. And credit spreads were starting to widen as well. So it was becoming more and more expensive for businesses to borrow, which was impacting consumers. And frankly, mortgage rates were going up. So he blinked then. So I think look for those circuit breakers and see whether he's going to blink this time. And history would tell you that typically, I don't want to get into politics here, but typically he might walk back when that happens. And that makes sense. You don't want to hurt your populace because you might struggle in the midterm elections, for example, if you hurt your populace. So I think circuit breakers are there. I think that was what you asked. I can't.
Yeah. I guess there's a reason for the acronym TACO, right? Hey, Sam, it's been fascinating to talk to you. You're a very, very smart man, and we appreciate your time. That is Sam Dickie with us from Fisher Funds.
Appreciate your time, Nadine.
And that is the Prosperity Project for this week. Thank you so much for tuning in. A reminder that if you do have any personal finance questions that you would like answered, or maybe you have a story to share, please feel free to send me an email, nadine.higgins@nzherald.co.nz, and we will see you next time on the Prosperity Project. A reminder that nothing we say here should be interpreted as financial advice.